I just want to point out to everybody, Dow's down nearly 520 points now. That is by far the lows of the session. There's been some technical levels breached in both treasuries and in the S&P 500. There's your market picture. Utilities, the only sector in the green today. We've mentioned financials, the sell-off there. Industrials, maybe a big give back from some of the euphoria out of Buenos Aires when stocks like Caterpillar and Boeing were ripping to the upside. That is not the picture at this moment. Let's bring in Ron Insana, who's joining us now on the phone. Seen a lot of markets in his day. Ron, what do you make of this? What is this about?
Well, I think it's about a lot of things. I mean, I think there's disappointment on multiple fronts. And, listen, the trade thing with yesterday's rally was a nod to the fact that it just didn't fail. Nothing was achieved at the G20 with respect to the U.S.-China trade relations as they stand. The fact that they were going to reopen negotiations is a potential positive. It's not a real positive. The tariffs are still in place. They haven't been rolled back. Chinese tariffs have not been rolled back either. And so in that regard, there's, I think, upon further reflection, given the kind of disparate comments we've heard and conflicting comments we've heard from the president and his advisors on what happened in Buenos Aires, you can pretty much take the positivity off the table. And listen, I've been talking all year about the prospects for a stealth bear market, about the need to raise cash throughout this year. And that's basically what's been going on. And groups are being taken out shot one by one. And the transport's rolling over. And I know Mike alluded to this just a few minutes ago, coupled with all of these other disappointments and misinterpretation or reinterpretation of what the Fed had to say about rates. You've got negatives building. And I happen to be more bearish on 2019 than most, both in terms of earnings prospects, global growth, domestic growth. Claims have been going up, which is an early indicator that the jobs picture might be starting to change. And you're getting market signals, including this, kind of fuzziness in the yield curve that says we should, take a pause and really kind of rethink our positions here.
Yeah. Ron, Dow's down nearly 600 points. Mike Santoli, I've got a note in front of me. It's a JP Morgan trading note. They're talking about overweights in U.S. cash and treasuries versus U.S. stocks for the first time in a decade. Are we really at the point where we've had a full paradigm shift about how investors need to think about where we are?
I think it does reflect what some people have already been sort of thinking, right? I mean, the flip side of saying, wow, that's a flat yield curve is saying you can lock in nearly 3% for a couple of years, with no risk to principal. And so I don't think that's usually the immediate catalyst for why bull markets turn into bear markets. It's not that people suddenly say, wow, I don't like stocks anymore, I prefer bonds. But I do think that when the market has already been volatile for a year, you have 10% corrections, that kind of thinking can come into play. So I don't know that that's really ringing a bell, but it does show you that there's a little bit of a higher threshold for what it's going to take to get risk appetites to get rolling again, to take a chance on stock. We've been talking also, though, about how stocks valuations don't look very demanding right now after this year of churn. Even if earnings don't fall apart next year, with yields down here, it doesn't look like the market's expensive. So that's not the reason that necessarily you're going to get chased out of it either. But I do think it's a more complex environment. You have multiple choices, and people are, I think, itchy as they look toward what feels like a very mature economic expansion in bull market, to feel like they want to anticipate when it might end.
Steph, NASDAQ back in correction. I mean, market feels like it's trying real hard to sniff out a recession, maybe sooner than a lot of people think.
It is, but then I look at the data, and I don't think it shows recession at this point. As I said, it's slowing. We knew because the fiscal programs peaked in the second quarter, so we knew that was the peak of growth.
We didn't expect, though, that we'd be talking about an inverted yield curve on Tuesday of this week.
Definitely not, but it's, as I said earlier, it's part of the curve. It's not the entire curve. And I look at other indicators that show pretty healthy growth still. So let's see what the Fed has to say, right? Let's see what happens with OPEC. Let's see what happens overall in the marketplace. Because one day is not going to freak me out, at least not out of the market, into some strong fundamentals.
Ron?
Yeah, let me clarify on the yield curve, I think. And I wrote a piece a couple of months ago about this after having spoken to Arturo Estrella, who's at Rensselaer Polytechnic Institute as a professor these days. He was the man at the New York Federal Reserve who did a lot of the original research on the yield curve as a predictive measure of future economic activity. What he corrected me on, and what I published at the time, was that the curve that they studied most at the Fed was the 10-year note to the 3-month T-bill. When that gets flat, or inverts, you have an average of 9 to 15 months before recession, with the average duration, the average signal time, about 12 months. Now, he had told me at the time, and the 10-year to 3-month bill was 100 basis points when we spoke. It's now down to 50 basis points. That curve has flattened dramatically. So it's becoming more and more of a yellow caution sign. It does not mean recession tomorrow. Remember also that bear markets precede recession. So you're not going to get a lot of lead time between a flattening or inversion of the yield curve and a bear market in stocks. That will happen in the real economy later. So I think, when we say, we don't see it next year, if the markets see it, if the yield curve does flatten to invert, particularly, again, 10-year to 3-month, you've got a year to prepare for what's happening in the economy. You don't have as much time to prepare what's happening in the stock market. They tend to be
that's a good
coincident.
point. Yeah, no, that's a good point. And let me also say that the gentleman you just spoke about, Ron, is not the only one who looks at that measure. Larry Kudlow and I.
Well, he got that from my piece.
We were having a conversation at Delivering Alpha on the sidelines about that very issue and what it was telling you at the time and what you're pointing out to us. It may be trying to tell us now. Dow's down 536 points, Joe.
Not surprised by the inversion of the yield curve, and I don't think the market should either. This is something 6 months ago we talked about. We talked about second half surprises. Stephen Weiss and I thought the yield curve was going to invert. I think what's happening, and Ron, if you could add some comments here, is I think there's parts of the economy, and that's the interest rate sensitive part of the economy, that is contracting so significantly that that's having the economic impact that we're seeing right now. Would you agree with that? And then there's other parts of the economy.
You're talking about
like
housing and autos and things like that.
Housing and autos are just brutal right now. But yet the manufacturing side, when you get an ISM print of 60 and you have a labor market that's incredibly tight as a squeaky wheel, it's a complete 180 in the economy.
Problem is that a lot of the manufacturing economy is being impacted by the tariffs. That's where the uncertainty maybe is felt more
I would
than
agree with
anywhere
that.
else.
But again, I think the focus right now, when you're looking at the yield curve, is on housing and it is on autos. It's on the interest rate sensitive part of the economy. That's what bond pricing is reacting to.